Hello and good morning, folks. This is Almus Market Mornings with Shikhar Garg, bringing the set of global financial updates just for you. Folks, after the central bank meeting in the previous week, we have their meeting minutes being released with the US Fed and RBI releasing one yesterday. Both the minutes, in their own ways, say inflation concerns haven't been out, even though there has been some moderation and the hiking of interest rates may continue. All this while they are also saying that they are keeping focus on the growth as well. But what's quite interesting, as we have been observing, is the mixed bag of actions by the central banks. South Korean central bank held the hiking of rates in this session, which is not so much in sync as compared with the rest of the central banks. So initially, we have observed quite a bit of sync across the central banks, which is now not so much visible. Another quite interesting thing to watch is the derivative short positions. Now, FPI have increased their holding of bearish positions on our index, reaching to an almost 6-year high. Quite a caution by the foreign investors is what we can observe. So, JK, what do you think of the minutes and this short position build up?
Good morning. Yeah, I think the 2 minutes were obviously what the market was watching for, and particularly the one from the Fed. But it was pretty much as expected, maybe a shade hawkish in the context of very hot data that followed the Fed meeting. Also of note is the absence of any mention of disinflation in the minutes, which contrasts with Powell's press conference, where he noted many times that the disinflationary process was underway. Key points, a few participants favored raising rates by 50 basis points, but in general, participants saw elevated prospect of recession in 2023. Bullard does not agree with it. And participants also said restrictive monetary policy needed until Fed confident that inflation can come down to 2%. And most of these are actually what we have been hearing from several Fed members all through the month, and therefore market did not see anything new in this. One point that they have touched about is the debt limit, which could pose significant risks to financial system and the economy. So that's what it is. And post meeting, we had Fitzwilliams saying again same thing, getting back to 2% over the next few years, the target. And although the goods prices have come down, there are signs that this may not go away as quickly as hoped. And Bullard is looking for rates to move to 5.375% as early as possible. But his target is surprisingly matching with that of what the market is now expecting. Also, while on the US monetary policy and the Fed minutes, interestingly, Bloomberg's artificial intelligence ran a model on how hawkish or dovish the minutes are, and the Fed minutes scored more dovish on widening diverging views growing in the FOMC. So we believe that the incoming data for February will not stop a 50 BP March hike, but could more certainly be for another 25. So it's going to be nothing different, but definitely more people see it as, not so hawkish. Yields were slightly lower across the curve, and that is quite reasonable, except for a sizable increase in the last couple of sessions. And as we reach the cycle highs, fresh longs by investors in treasuries were evident when we look at the 5-year bonds, which yielded lower compared to yesterday, despite a very large 43 billion new issuance by the treasury. The study says that 6-month T-bill now yields 3% more than S&P 500 dividend yield. And in a year of full uncertainty, we cannot fault investors for taking advantage of such rises in yields. And it really requires a shocking beat on core PCE inflation tomorrow to get to new highs on the yields. So on the stocks, it was a choppy session in Wall Street and no major bearish follow-through for equities, though mostly they ended in negative territory. For two reasons: the market was position short already after the Monday's events, and Fed minutes held no surprises, as most Fed members already have been talking hawkish for several days. The composite index of global stocks were down 0.51%, and now markets are now slowly pricing in higher rates for longer and can only rally with the positive news on inflation. Commodity space was quite soft, with the Brent dropping below 81 on growth and demand concerns after Fitch indicated moderation in expectation about China growth. Coming to Indian scenario, the price pressures as per the minutes of RBI remain high, and it will be premature to lower the guard on inflation. which majority of the members of RBI, the minutes published on Wednesday says, the governor said we must remain in an unwavering commitment to bring down inflation to 4% target in the medium term while being mindful of growth. Members are also concerned about the persistence of core inflation at elevated levels. But I think what we should take note of for two dissenters who wanted the rates to be kept on hold, Jayant Verma and Ashima Goyal, and with Jayant saying that the policy had become complacent about growth, and when MPC tightening it will fully pass through, it will further reduce demand. As you said, we have started seeing central bank actions this week. Yesterday, Bank of New Zealand, Reserve Bank of New Zealand hiked rate by 0.5%. At the same time, Korea held rates steady without any change. And basically, now we are actually turning into a situation where domestic inflation and domestic growth prospects are driving the policy rather than blindly following what the Fed does. So that's the scenario. Oh, for the rupee, very little consequence of MPC minutes, and we continue to trade in the same range. Even as we observe the stock market, which has once again come to the lows. Yes, I think foreigners definitely are cautious on the Indian prospects. See, I think there are two conflicting things here. One is the valuations of Indian stocks, which is still quite high, on a global basis. At the same time, nobody wants to miss out on the India growth story. So possibly that's what the investors are protecting themselves against. And also it's an election year going into a lot of whipping volatility. Cannot see why FIs are remaining cautious. But for rupees prospects, I think I'm more watching out for resumption of FDI flows. And there are also reports that NRI funds have been really surging into India. So all these things should help rupee be showed up to slightly better levels from the current 82.80. And maybe in the financial year end, historically, we have seen rupee getting stronger. Whether it will repeat or not, that is something I want to wait and see.
Interesting, JK. That's quite good. Folks, what really caught my attention was the 6-month T-bills earning more than the S&P. This was quite an interesting event to watch out. But as JK mentioned, folks, the RBI governor did say we shall remain unwavering in our attempt to bring down inflation, all the while focusing on the growth. So it's quite an interesting setup to watch, as it is rightly being observed that the central banks are basically taking action basis the domestic prospect, domestic inflations, and the growth, which is driving the policy rather than the blind following of the US central bank. Now this is a big development across nations and shall bring in quite a bit of changes across international markets. But what really is going on is the resumption of FDI flows that can be expected. Although it has been 15% lower in the past 9 months, a resumption can bring in some bit of flows, which can, as JK mentioned, lead to INR strengthening against the dollar. So let's see how things go about in the markets. That's it for today, folks, and we shall come back again tomorrow with another round of updates. Thank you so much for listening.